Did you know that nearly 40% of Americans are one paycheck away from financial disaster? If you're one of the many struggling due to job loss or reduced income, unemployment insurance, UI, can offer a lifeline. But there are challenges, especially when trying to use those benefits for big expenses like mortgage payments. In today's video, we're going to break down why it's not always as simple as it sounds to rely on UI for keeping a roof over your head, and what you can do to make the most of this critical financial support. Welcome back to Factful Finance, where we help you make informed, smart decisions about your money. Before we dive in, just a quick note, this video is for educational purposes only. I'm not here to offer personalized financial advice, so always consult with a professional when making big decisions about your finances. Now, let's get started with the challenges of using unemployment insurance to cover your mortgage payments. The first thing to consider is the amount of money you actually receive from unemployment benefits. In the US, for example, the average weekly unemployment benefit is about $370, though this can vary depending on your state and previous earnings. Compare that to the average mortgage payment of over $1,500 per month, and it's clear there's a significant gap. If you were relying solely on UI to cover this, you'd be facing a shortfall right off the bat. But the challenges don't stop there. While unemployment insurance is a great emergency buffer, it's usually intended to cover basic living expenses like food, transportation, and utilities, things that are essential, but not necessarily large, long-term expenses. Mortgage payments are a bit of a different animal. They're a significant, ongoing commitment, and the financial strain becomes even more difficult to manage if you're already dealing with the stress of job loss. Now, let's dig deeper into why using UI for mortgage payments can feel like trying to patch up a leaky boat with duct tape. For starters, unemployment benefits have an expiration date. The average duration of benefits is about 26 weeks, although that can vary based on your state and the overall unemployment rate. This means that once your benefits run out, you're left to figure out how to cover those mortgage payments on your own, at a time when you might still be struggling to find steady work. Consider the case of Mia, a single mother of 2 in Ohio. She was laid off from her job last year and started receiving unemployment benefits. Mia's weekly benefit was just under $400, but her monthly mortgage payment was $1,200. For a while, she was able to use her benefits to cover the difference. But after several months, when the benefits ran out, she was faced with a decision: fall behind on her mortgage or dip into her savings. Unfortunately, Mia didn't have much saved up, and her credit took a hit. This highlights the risk that unemployment benefits, while helpful in the short term, aren't always sustainable for large, ongoing payments like a mortgage. On top of that, many homeowners are unfamiliar with programs that could help them bridge this gap. For example, some states offer mortgage assistance programs for those receiving unemployment benefits. These programs are often state-specific, and they might be underfunded or have limited availability. Even when assistance is available, the application process can be lengthy and complicated. For someone already under stress, the paperwork and eligibility requirements can be overwhelming. Let's talk about the other big challenge: the emotional toll. Losing your job is stressful enough, but worrying about how to pay the mortgage only compounds that stress. Research has shown that financial stress can lead to mental health challenges, including anxiety and depression. In Mia's case, the fear of losing her home made it harder to focus on her job search. Financial insecurity can be paralyzing, leaving you unsure of where to turn for help, and not knowing whether you'll ever be back on your feet. So what can you do to navigate these challenges? First, it's important to know your options. If you're receiving unemployment, reach out to your mortgage lender and ask about forbearance or loan modification programs. Many lenders offer temporary relief to homeowners facing financial hardship, especially in times of crisis. The key here is to act early and be proactive. Don't wait until you're already behind on payments. Also, consider supplemental resources, such as housing assistance programs that may be available at the federal, state, or local levels. The U.S. Department of Housing and Urban Development, HUD, has a directory of these programs, and some nonprofit organizations also offer financial counseling and support for homeowners at risk of foreclosure. And finally, if you find yourself in a tough spot, don't be afraid to ask for help. Whether it's from a financial advisor, a local government program, or even a supportive friend or family member, the sooner you get assistance, the better. Before we wrap up, let's quickly revisit our disclaimer. The information shared today is for educational purposes only. While I'm giving you insight based on the facts and trends I've seen, it's always important to talk to a professional before making any financial decisions. Unemployment insurance can certainly help during tough times, but relying solely on it to cover major expenses like a mortgage can lead to serious financial strain. By staying informed, reaching out for help when needed, and exploring available resources, you can weather the storm without losing your home. I'd love to hear from you. What's your biggest concern when it comes to paying your mortgage or managing your finances during unemployment? Drop your thoughts in the comments below. Thanks for watching Factful Finance. If you found this video helpful, be sure to hit that like button, subscribe, and ring the bell so you never miss an update on how to take control of your financial future. And if you're ready to dive deeper into other financial strategies, we think you'll find the next video shown on the screen useful for your goals. Take care, and we'll see you in the next one.